Welcome to Nasdaq TradeTalks, where we meet with the top thought leaders and strategists in emerging technologies, digital assets, and regulatory landscape and capital markets. I'm your host, Jill Malandrino, and joining me on the desk at the Nasdaq Market site is Michael Sokoll, AVP with the Nasdaq Market Intelligence Desk, Todd Walsh, CEO and Chief Technical Analyst at Alpha Cubed Investments, and Michael Di Gioia, Chief Technical Analyst at DOS Trader. We're here to discuss the fundamental factors driving the market narrative and what the technicals are confirming. It is great to have everyone with us. Welcome to Trade Talks. And Todd, a lot's happened over the past 6 weeks. If you thought this was going to be a quiet summer market, I feel like we fall into this trap every summer, but a lot has happened, particularly with this most recent bout of volatility, which in a way almost felt as if a pressure valve was released. We kind of got out of our own way with questioning valuation, and there was somewhat of a reset there.
I mean, we've been expecting a consolidation in the tech names, the AI names, for how long, right? It had to happen eventually. Trees don't grow to the sky. So in a way, this was kind of expected, but the timing around it, no one knew when the timing was going to be. So we're not surprised it's happened. And we think there may be a little more volatility to come, because market corrections are like earthquakes, right? Absolutely. They don't just happen as events and then disappear. So we've had a nice recovery, but I don't think we should just relax and think everything's going to be okay. There's a lot of catalysts for volatility left.
Without a doubt. I mean, usually what you see is a big run up. Markets tend to move, 70% of the move in the last 30% of time. We got a very big consolidation into those, the Magnificent Seven. Things got really, really overbought, and then you need a shift to the downside to bring in some of that volatility. Now what you got to watch for is if the market fails to make a higher high, it might make a lower low. So where the market stops going up and where it starts to fall, and then where it bounces back to, is what we need to watch technically. Yeah, I'd love to hear about the fundamentals.
Yeah, and Michael, I mean, there's obviously a lot that we have to pay attention to, not only the fundamentals in terms of where valuations sit, of course, geopolitics, there's always something to worry about there. We have the national election coming up here in the US, and when we even isolated to earnings season, it's also been about, you could be on the quarter, but guidance is so key. And then also factoring what Fed policy could look like. There's a lot to climb a wall of worry here.
Absolutely, and at the end of the day, you had a better than expected earnings season. Earnings grew, a little over 10%, and they were looking at a lower number going into the beginning of the earnings season. The beat rates, which you tend to ignore, were about in line, but a lot of companies missed on revenues, more than usual, I should say. It was only about 58% beat on revenues, and companies were penalized more if they missed. You had more variation in both the upside and the downside for companies that reported. So a lot going on. The other thing is you have hopefully a narrowing now of less of the earnings concentrated in the Mag 7 versus, and going forward, that's the expectation, that instead of having 35% of the earnings growth all being the the top 7 companies, you'll have some more spread out over some of those other companies.
Yeah, and that's what we've been talking about for I don't know, the past 18 months, is concentration risk within the Mag names, and it is starting to spread out in some ways. I mean, we are seeing, breadth stabilize a bit here, and it doesn't feel as if that concentration is quite so magnified, if you will.
Yeah, and helped by, we've had the sell-off.
Right.
So now some of that pressure to be perfect is kind of out of the market now. Right. And it's kind of amazing when you looked at last week. If you looked at the week-over-week change, you were down 0.4%. It was the second smallest change in the market all year.
Right.
But after what happened Monday, who'd have believed it?
In the backdrop of chaos.
Yeah, would have believed that.
Which is so interesting, because Todd, when on Monday of last week, spot VIX was 65. If you look at the futures, it was in the mid-30s. It wasn't as if the longer-term volatility was something that investors expected to stay. So when you see those charts come out, it was the third highest period of all following the financial crisis and COVID. Those felt like longer-term systemic things, not necessarily, an unwind trade, if you will.
Well, remember, with the carry trade blowing up, no one knew if there was, victims that weren't really being realized that were leveraged and in there are going to, cause more damage to the system. So I don't know if we're even fully beyond that, because we don't know what players were significantly damaged there. But we're at a really interesting technical point right now. The daily technicals are at an inflection point. They've been negative for a couple of weeks now, and we're sitting right in front of the biggest economic news report in quite a while, the CPI report. Yeah. If it's too hot, not great. If it's too cool, not great. It's got to be just right, and we got to thread the needle here, or we could see more volatility. And as Michael mentioned, I really wouldn't be surprised to see a retest here, take out those lows, scare everybody. The Fed needs cover to lower rates. They can't raise rates or lower rates into a constant stream of all-time highs. They need to maintain their credibility after what happened in 2021. So we've been saying for about a year, the Fed needs a little mini crisis to be able to lower rates. And that scenario kind of suggests maybe we get a retest here. We'll see. Tomorrow's the big day, though.
Yeah, without a doubt. I mean, I just wanted to bring up that timing is everything in trading. And just look at the timing, right? The sell-off occurred in earnings season, in August, right? One of the lowest volume times of the year. We're going into the last 2 weeks of last 2 weeks of August, and with the exception of the space between Christmas and New Year's, this is the other low volume time. So if there is a big move, okay, then a lot of times you say that that big move has less significance because of the time of the year that it's happening. So we've made a big move down, we've made a significant move back up. Now we got to watch where that high goes, and then where does it go after that high is established. That's what traders are looking for. And the fact that we're coming out of the end of this slow period, what does it do in early to mid-September? Because that's when, you know, the main traders are at their desk, right? I mean, the summer doldrums have come to an end. Everybody comes back to reality after summer. Let's see what happens in early to mid-September. That's the tell time.
Quickly on that point, I read that only 5% of your new highs over since 1980 come during the summer. And in Q4, it's like 50%. Yeah. So to your point, you have a chance of retesting the lows and maybe have a rally.
And I think the other great point that you bring up as well is time frame, right? There's something for everyone in a move that we saw. It could be great for day or swing traders like a DOS trader. It could be great for someone like myself who's a long-term investor where you stay in, kind of set it and forget it. And if you pulled out of these periods of extreme volatility, that's when you could miss out on a significant move in your portfolio.
And to your point, I don't want to break any news here, but we have an election coming up.
Yeah. Right.
And the market hates uncertainty. And we're in the middle of all those factors plus the election uncertainty. And I have to be honest with you, I think we're going to have a really clear picture of what the rest of the next month and a half is going to look like after about, the 6 a.m. tomorrow morning, California time.
Yeah. Well, and that was, another thing, Mike, from a fundamental perspective where people were perhaps calling for an intra-term rate cut. To me, that would have been a surprise event, right? That signals something is really, really wrong when in fact the economy is not doing that bad where you need, an inter-term rate cut.
Yeah, and I saw that Monday, lots of headlines going by
Right.
that you would need that. And to me, that scared me, the fact that somebody would consider that, because then of course that means there's way worse things. I think you'd probably be counterproductive in doing that.
Right.
And then that kind of stopped, and we're now back to 1 or 2 rate hikes depending on, what you believe in terms of the September meeting, and then maybe 1 to 3 more after that. So, but to your point, it's hard to do that in the teeth of all new highs. So you have to kind of thread the needle. And I don't want to say price for perfection, but we have a lot of good news baked into the market. And if things don't go quite right, either too hot on the inflation, which that's where the surprise is going to come from, right? If everyone thinks it's going to go lower, a lot of things have to go right. Fundamentally.
It seems as if, Todd, the market narrative just constantly shifts at a higher rate. I mean, think about it, at the end of December, 6 to 7 rate cuts, the market was celebrating that. I don't know, in my mind, if we get 6 to 7 rate cuts, that signals on a larger scale, things are not that good.
Yeah, it's like a high velocity tennis match this year. Our position was there's not going to be 6 to 7 rate cuts back in January. The Fed needs cover, the market's making new all-time highs. We've been encouraging people to broaden out their view, breathe, don't act so fast. Everyone's myopically focusing on the Mag 7 and the emergence of AI, sort of like the PC and internet revolutions, and rightfully so. But we've got to look at the rest of the market for opportunities when something gets valued at a sky-high level. We see the value trade and the dividend trade working really well since the Fed made one change. When they pivoted last November, the value dividend trade has kept up, believe it or not, through today with the white-hot Nasdaq 100. And we think the Fed is now about to shift to an easing cycle, a more dovish cycle. That's another shift that's going to put the wind at the back of the value dividend trade and help a little safer sector of the market contribute to returns. I call it having your cake and eating it too. So hold your tack, use volatility to add to those names if you're a little late to the party, which a lot of people are, let's be honest. But don't look away from some of those areas that the Fed's going to be favoring, which we think is the value dividend trade. And it's been 100% right since that last pivot.
Yeah, and it sounds like welcoming news to me for a little bit of stability and broadening out.
Right? That's why I say having your cake and eating it too. You can sleep at night.
Yeah.
I mean, I look at the markets, especially technical analysis, as illustrating human emotions on charts, right? So we've been in a prolonged period of greed. Now we had some uncertainty introduced into the market, and that uncertainty came into the market rapidly. Why did it come in rapidly? It's because there's so many computerized systems trading, right? So once a trend line breaks, that computerized system is programmed to sell, sell, sell. And then all the traders have to jump on. And then you got the options traders and the day traders, and they're all trading volatility, and they're trading short term. So that quickens the market overall. We've gone from prolonged period of greed. Now we had a little bit of introduction of uncertainty. We'll probably have more uncertainty until the election, because we have huge decisions being made. And until that uncertainty is cleared out of the market, we're not going to know exactly which direction we're going. So this initial peak and drop has established a range for that uncertainty to live in while we make this decision. So I just look at it from that perspective. We're in the emotion of uncertainty, so volatility rules, volatility trading. If you're going long, go long near the bottom of the range. If you're going short, go short near the top of the range. If you're going intraday, you can play it any way you see opportunities.
And to your point, investors have been conditioned to have things be over quickly. Short correction, get back in. The market confuses the majority of the people the majority of the time, and I think we might be sitting right on the precipice of a little bit more volatility, not gloom and doom, not ending the bull market, but sort of normal volatility after the run we've had.
Yeah, I mean, if you think about it, look how people were getting short vol at the bottom, right? And I think that was also part of that trade that we saw as well. We had to start covering, because it's almost the opposite when you think about the volatility markets. It's like stairs down, elevator up, right? Yeah. And it's the inverse with the equities. But I feel like, to your point, Todd, for the past 15 years, we've become so predisposed to liquidity with whatever form in the market, stocks at the bottom left to the top right. Then you throw in, which there really is no benchmark for in modern markets, the pandemic and how that kind of changes the composure of market structure and participants. And there's a generation of investors and traders who just aren't used to the ebbs and flows. This is normal. Like the interest rates that we're sitting at right now from a historical perspective, whether it's regular interest rates or mortgage rates, it's historically normal.
Sure.
I would even say that inflation is almost historically normal.
Yeah.
I mean, it's not at the Fed's optimal 2% number, but I mean, historically, this is slightly off that number. Now, the question is whether or not that number is truly accurate, and is it really digesting everything that's going on in the economy?
Right. Well, I mean, there's also backward-looking data that they are basing policy on as well.
And I think that 2% number sort of came out of that time when we had 0% rates for such a long time. They were trying to get to a 2% number, so they threw that out there. But I think 2 to 3 might be more your normal state of affairs, given how the economy is operating now.
Yeah, I mean, there really is no roadmap for what it looks like getting an economy and a marketplace out of a pandemic. I mean, 100 years ago, certainly, market structure was different. We weren't even talking about these types of things. So it's not as if the Fed has a distinct roadmap to formulate policy. And the thing is, we're just not used to exercising patience in any form.
We are in an era where investors have become complacent. In the 2000s, we had a lot of volatility up and down. In the 70s, we had a lot of volatility up and down. But I think the emergence of AI looks a lot like the emergence of the PC ecosystem. And we need to have that situational awareness of realizing it's not going to go straight up, but we're going to be talking about this for a long time. It's not really ready for prime time. We're changing the narrative to what's the ROI, which is a normal sort of adjustment from trees grow to the sky. And it's okay for these secular trends like the emergence of the internet in the 90s and PCs in the 80s to take a year or two off. I don't want to believe that, but it could happen at any time. We see bull markets take a rest for a while, and maybe we're on the front edge of a period where the entire sector takes a breath and consolidates the torrid historic gains of the last 18 months.
And I'm just going to bring up that you have corrections through time, which is going sideways, and then you have corrections through price, right? So you get pulled back to the moving averages if that's a correction through price. So a correction through time is actually a healthier correction.
Right.
Meaning that we've been going up for like 13 to 15 years, right? So since the last financial crisis, we've had an up market. If we correct through time and just chop around sideways, that allows the market to digest all of that movement in a kind of healthy way, as opposed to a correction through price, which is a drop down, and then you start to bounce back up slowly.
That's why it's called averages, right?
That's right.
It's not bad getting 8% average over the course of 20, 30, 40 years, and I think we're just not exercising patience or diligence, because whether you're trading intraday, swing trade, or longer term, there is a method, and the management of that is an art. It's not as simple as point and click, and you've made. That's not normal. That's the anomaly.
Well, to your point, from 2009 to 2022, the market was in a bullish technical condition. But there were long periods in there where the market made absolutely no headway. And it didn't change the nature of it being a bullish technical condition. But if the market's going to average 7-10% over the long run, and we do 30% last year, it can't keep going at 30%. The way I do the math, it has to slow down a little bit. And maybe, like I said, maybe we're on the cusp of one of those, which is why it makes sense to broaden our horizon and look at some of the other sectors like the dividend value trade, which the Fed is telegraphing that they want to support.
Yeah.
Let's go back to the macro for a moment here, Mike, because on the Markets Intelligence Desk, you talk directly to Nasdaq listed stocks, which are issuers, right? What are you hearing from management teams in terms, on a high level, how they feel about the economy?
Yeah, for a long time, well, it was, what about me? Because the S&P 500 was making all new records. If you were a Russell 2000 stock, you were wondering, why am I being left behind? And there was some frustration. There was quite a bit of frustration because they're like, I'm doing all the things I'm supposed to be doing, but I don't have that AI tailwind or the mega cap, because don't forget, all the broad indexes are fueled by the momentum in the big cap stock. So, you know, Apple's bigger than the whole Russell 2000 market cap. So it was very tough for these companies to get there. I think, to your point about the value trade, that's turning around a little. Some companies are getting some headway now, and it's not just about the Mag 7, at least over the last couple of weeks, which I think is good for those companies.
Yeah, well, Mike, that was one of the concerns going into the correction that we saw, the dispersion of how the Russell 2000 was trading relative to the other indices. I think when you see a move, whether it's to up or downside, in such a short amount of time from an area that was not participating and couldn't get off the finish line, that it just felt, I know that's not an investment style, how it feels, but it just seemed as if the move didn't necessarily make sense or adhere to the averages.
I mean, so for me, in looking at the recent correction, we got a lot of selling in those big names, and that was really necessary diversification into the value trade, the dividend stocks. It started to allow other stocks in the market, the broader market, to start to participate. And now we're going to start to see that rotation out of just the big name tech names, which technically the sector that leads the market in is also the sector that usually leads whatever correction out. Meaning those are the names that made most of the gains. So they're going to be the first ones to sell off, and then that money is going to be recycled or rotated into the other sectors, namely value, dividend stocks. And I agree with you. I think that they haven't gotten any attention. I agree with you that the Russell 2000 hasn't got any attention. This big run up has mainly been in those big 7 names.
Yeah.
And those ancillary names that are similar to those companies.
We've been telling our investors that the Mag 7 have been driving returns, but there's a whole other market out there. We call it the forgotten 493, right? And they've been sitting around waiting for the Fed to see if they're going to make another policy mistake.
I like that.
But maybe this shift that just happened, this bellwether shift, is really an indication that we're moving to a broadening out of the market, like you mentioned. And this event that we've seen is kind of the new temporary normal for the next, I don't know, 6 to 12 months, because you know, if AI is really going to get built out the way they say it is, if CapEx is going to continue at the level that it looks like it's going to continue at, we're going to be talking about AI for a long time. We can't forget about it, but it's okay for it to take a little time off, consolidate, and let the rest of the market benefit from a shift in Fed policy.
Well, I mean, Todd, in the first quarter of 2024, didn't the other 493 return an average of about 8.25%?
First quarter of 2024?
It's somewhere around there. It wasn't like they were negative relative to.
They've picked up a little bit.
Right.
When the Fed shifted to a pause, they got a breath of life in them. But to your point, it happened, but a lot of investors aren't aware of it.
Right.
Because they've been in asset allocation programs, over-allocated, not in the center of the AI ecosystem build-out, and they've missed the returns. They lost money in 2022, missed the returns in 2023. There is so much investor fatigue out there as we get into 2024 that people have been flocking sort of myopically into the Nasdaq 100, the hot tech names, and as is normal investor behavior, kind of doing it maybe at the wrong time. Working with retail high net worth, we get a lot of sort of, feedback from our clients. We get a lot of emotional reactions to things, and people were really focusing on that sector, maybe to their detriment too much as we were kind of entering the second quarter.
Yeah, but from a portfolio management perspective, Mike, if you have not been involved in, let's say, some of these MAG names, right, and you get that 10-15% correction in a name, I mean, wouldn't you almost have to get involved with it?
I would say, number one, I love Forgotten 493. I think that's awesome. I think that's a great, but also what he mentioned was that you need to have like 6 to 12 month outlook, right? So you can't just jump into these other names and expect things to start going immediately, right? We like to think about uncertainty like, okay, we now know who the president is, but who is the cabinet? What is the rest that comes with it? There's a lot of decisions. It's going to be a 3, 6, 12-month period for us to get through that uncertainty. You got to get the new president in the office, right? And then see what their first 100 days are like. So whatever happens, you need to diversify out. You need to give a little bit more action to other sectors. It's not all about tech all the time.
Right. All right. We'll leave it at that, gentlemen. Appreciate the insight. Thanks for joining us on Trade
Thank
Talks.
you very much.
And thanks for joining me from MarketSite. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.